Thank you, Mr. Valecha, for being with us today. It's a pleasure having you. Today we are seeing stability on oil prices after 2 days of retreats. Also, we have a factor which is France, the demonstrations impacting the supplies, but the main factor is the Fed, the US economy, the Chinese demand. What do you watch today?
Well, majorly, of course, what we have to look at is the US Fed. The US Fed, especially after the comments that have come in this week, that interest rates can also go up till 6%, is a major driving force in the market. We actually saw much less of a reaction on the market given the comments were extremely bearish. But however, that being said, the non-farm payrolls numbers are expected to be good, and that is what is stabilizing the economy right now. Uh, Chinese imports have not been as good as we expected. Start of the year really started optimistic that China will actually increase imports, but that has not been the case. So there is a bull and bear case right now. Markets are taking in all the news, and hence the markets are remaining flat today.
You mentioned the Powell statements, and we started to hear from some of the investment banks that we shouldn't wait less than 6% as final interest rates. Risks assets were impacted by Powell yesterday, stable today. The futures are high. How do you explain this behavior by the investor or the trader?
Well, majorly the behavior has come in because the ADP numbers came in much better than expected. We also saw stellar non-farm payroll numbers in February, and we are expecting 200,000 plus jobs to be grown in tomorrow, coming the data tomorrow as well. So, well, there's no major reason to be panicked because unemployment is not a problem even now. Inflation definitely is. Rising interest rates and unemployment will cause a very big problem. But as such, just rising interest rates without unemployment is a problem which can still be stabilized. So, as long as the non farm payrolls numbers come good, jobs data is good, and more importantly, the interest rate hikes are not harsh if they are at the rate of 25 basis to 50 basis points, which is expected, the markets might be able to take it in. However, that being said, 6% is a very high number. We have not seen the Fed rates reach 6% in over 2 decades, and that is definitely a cause of worry.
In fact, it's a little bit confusing. According to the latest CFCE numbers, long positions are increasing again. Do you see these numbers? What we are seeing in the markets today?
Absolutely, it is quite confusing. We are seeing mixed data from the economy itself. The GDP numbers are not coming as bad as expected. The economy is different, the markets are different. We have always said that. The economy is not showing signs of a recession. The markets also are pretty much holding up. But at the same time, what we do see that the dip has only come in the tech sector, and that is something which is continuing. Jobs is increasing elsewhere, and more importantly, what we are seeing is that however bad the situation is getting, the market is more and more capitalizing on it. It is getting more and more accustomed to it. So even if we do see the rate hikes much more faster, I don't think it will be a catastrophe what we've expected start of last year.
And also, we would like to ask you about the metal that everybody would like to know about gold. Gold is retreating to 1810, and now it's a little bit rebounding with this weakness of the dollar. You were expecting that gold would retreat. Do you expect more retreat?
Well, we are seeing a certain pullback which will come for the next few days, probably the entire next week as well. But overall, given the current situation of the interest rates, as well as the fact that the markets are not falling as much as anticipated, there is not much reason for gold to be bullish. Gold is expected to continue the bearish nature, and we could see levels of almost 1650 also on the short term side.
Thank you very much, Mr. Valecha, for being with us today. It was a pleasure, Ali.
Thank you so much.